Good evening, ladies and gentlemen. Please can I ask you to take your seats? Many thanks.
Good evening, ladies and gentlemen. If you would be able to take your seats, please. Good evening. Welcome. Welcome to the news building. My name is Will Wilkinson. I'm the General Manager of WSJ Pro. It's my honor to welcome you here tonight, and great to see so many of you making it out on a weekday evening. WSJ Pro is a membership-based service that's built on the content from the Wall Street Journal and data from Dow Jones. This is one of the many events that we host in London and cities around the world, in the US, across Asia. We'll be in the spring, back here in the spring as well. And these events are designed to bring together our experts to talk about topics that are in the news, give insightful conversation and discussion. And this evening we're particularly happy to welcome our friends from INSEAD, who helped us make this evening work. For those of you who are interested in learning a bit more about WSJ Pro, please see me or any of the team that are here in the evening. And I won't keep you from the main event. have a very enjoyable, stimulating, and thought-provoking evening. Thank you.
Gentlemen, please welcome the European editor for the Wall Street Journal, Thorold Barker.
And everybody else, please. Good evening, everybody, and welcome to the Wall Street Journal's equivalent of the Jackson Hole gathering. We have assembled our central banking experts from around the world, from Washington, Beijing, Frankfurt, and from London. And it comes at a fascinating moment where two of the anchors underpinning the world economy and markets have become dislodged. First of all, in China, where very rapid economic growth that everybody assumed would continue forever has stalled, or not stalled, but decelerated significantly and left people wondering what happens next. At the same time, the Federal Reserve, which has kept interest rates at zero for 7 years and engaged in a very aggressive quantitative easing campaign, is looking to raise rates. So those two things have changed, leaving markets volatile, businesses unsure what will happen next, and ever more focus on the response of central banks. So to discuss this, we have a fabulous panel. We have John Hilsenrath in from Washington. He is our chief economics correspondent. Brian Blackstone from Frankfurt. He is our central bank's editor for Europe. Ling Wei is in from Beijing, who is our central bank reporter. And Jason Douglas, who's come up from downstairs, and he is our central bank correspondent covering the Bank of England. We're going to have a debate for around 40 minutes here on stage, and then we will open it up to questions for about 20 minutes at the end. So please have a think about that. And for those of you who are on the live stream, this is being live streamed this evening to people, you can send in questions via Twitter at hashtag WSJ Pro. So we'll come to you as well at the end. But just to kick off this, I just wanted to start with John. The Federal Reserve has been center stage for a long time now, and they've attempted to position the market for interest rate rises, and they've backed off so far. But you are talking to these people every day. What is actually going to happen next, and particularly in December?
Well, Janet Yellen was testifying before Congress today, a week after the Fed had a meeting and put December officially on the table in their policy statement. They said for the first time they could do something next month, and she kind of backed up that argument. The Fed has been in a difficult spot this year because they've been signaling since the beginning of the year that they might raise interest rates. When the year started, they thought the economy, and in particular the labor market, were finally getting close to strong enough to start raising rates. And what happened is inflation hasn't behaved as they expected, and they've gotten a series of disappointments and shocks which have thrown them off. So originally it looked like it was going to be June, and then it looked like it was going to be in September, and now we're talking about December again. The first shock was contraction in growth in the first quarter, which delayed the June liftoff. And then the second shock, which we'll talk to Ling about later, was slowdown in emerging markets, which became increasingly apparent to the Fed during the summer, in particular in August, and they got cold feet about moving at their September meeting. It's starting to look like the smoke is finally clearing, that they're reaching some level of comfort about the global environment, and Janet Yellen would like to get this over with. Their credibility is in part on the line because they've been signaling for months now that 2015 was going to be the year, but they say they're data dependent. So, and Yellen just talked about this today in her testimony to Congress. They want to go. It's going to depend on how their forecast evolves over the next couple of months. We're going to have jobs data on Friday, and if those numbers look like they're holding up, I think they'll be inclined to move. But if the data disappoint, and they had been somewhat disappointing in September and October, they might be forced to hold off again. She has a difficult policy committee that she's dealing with right now. She has personalities in the room. She's got to get as many people as possible, of 12 actually, to vote for her, and she's getting resistance on both sides. So one of the things that she's really working at right now is trying to build a coalition of support to make the next move.
But all things being equal, you think December's a likelihood?
Well, you know what? I'll tell you on Friday, and we'll be writing about it on Friday. It's so much is going to depend on this jobs report, because if the jobs numbers that come out Friday morning are strong, if we see 150,000 plus on payroll growth, if we see the unemployment rate come down a little bit, if we see some signal that wages are picking up, those are all signals that I think the center of the Fed's committee could latch onto and use that as a reason to move. But there's a lot to talk about what happens after that, and I don't want to hog the stage.
So Ling Ling, one of the issues that stopped the Fed moving last time was market volatility, and the fact that stock markets sold off aggressively, bond spreads blew out a bit, and a lot of that was around uncertainty in China. People looking at China and not really understanding what's going on there. Can you give us a sense? I mean, you are in the mix in Beijing, you're talking to these people, and you have broken some fabulous stories around what the central bank and others are doing. They've cut rates, I think, 6 times so far this year, and they've been aggressive on stimulus. Can you give us your sense of how the Chinese economy is placed and what the central bank will do over the coming months?
Sure. Within the government, there is a strong sense that the economy is worsening faster than they initially expected. The central bank has taken a barrage of measures, as you said, 6 interest rate cuts since November, but hasn't really helped the economy very much. So that means that the central bank will have to keep on easing. As you guys know, that China's central bank is not independent. It answers to the top leadership. And the top leadership has this target of maintaining 7% growth rate for this year. Very high by all measures, but by China's standards, it actually would be the lowest level in a century. So the government is trying to really meet this target, but the problem is that a monetary stimulus hasn't had the effect they desired to, help spur the economy, because China still have this overhang of a huge stimulus package in 2008, 2009. At the time, China spent 4 trillion RMB worth of credit on spurring the economy, and the result of it is a huge overcapacity in a number of industries. So China is still dealing with that, residual problems from that stimulus. So that means that every dollar, every credit, every yuan of credit China is spending now is having diminishing returns on, the output. For example, some analysts are estimating that in the past, 1 yuan of credit would lead to about 6 yuan of output, and now it's only half of that. So you're having this diminishing returns. But
just one follow-up on China specifically, and we'll come on to Europe and the UK, but just how aggressive will the central bank get if it needs to? I mean, will it pursue what Europe, what the UK, what the US has done, which is to actually go to quantitative easing to start buying bonds and other things? Do you think that will be something that they'll be willing to do if they need to?
That's a great question. There has been a lot of internal debate within the PBOC over that. But one issue is that even if they want to do now, they can't, because by Chinese laws, the central bank cannot directly purchase bonds from the market. So it will require a change of law to do that. What China's central bank has done is they have done something similar in nature to the Western style QE. For example, China has launched a gigantic debt for bond swap program aimed at helping local governments pay off existing debt. So what the local governments do is they would sell bonds to banks and then use the money to roll over and pay off their existing bank loans. So in order to encourage banks to buy those bonds, the central bank put into place a program where banks can use those bonds as collateral to borrow from the central bank.
So they're trying to do it in a more subtle
Can I
fashion.
say something
Yeah.
about the whole idea of QE in
China.
China?
What the developed world has been forced to do is, as when interest rates got to zero, they basically, their main lever for affecting monetary policy in the economy disappeared because of this idea of a zero lower bound. They couldn't push them higher. They couldn't push them lower. So they turned to this other policy called quantitative easing, purchases of bonds, as a new way to stimulate the economy. Rates aren't at zero yet in China, so it's not clear that they have
They've
to
got a
take
bit of
that
way to
step.
go.
But this other debt for swap issue is really important because the problem is in local government, local and state governments. Yes. And like it seems to me this is a way of trying to start attacking that problem and all the debt that was built up in these state and local governments.
Absolutely right. The debt problem is one of the biggest risks facing China's economy right now. As most of you know, debt to GDP ratio in China has risen to almost 280% from less than 200% in 2008. So you see this rapid buildup of credit in China's economy. That's a huge problem.
Just to bring Brian here quickly, I mean, we've talked a little bit about the aim of the Fed to raise rates, the rapidly slowing economy in China and the response to that. Obviously, Europe is one of the major economies of the world and is very sluggish and has resorted to both QE on one hand, but also negative interest rates on the other. That hasn't had the effect that some might have hoped from an inflation and growth perspective. Can you give a sense, Brian, of how Europe fits into this mix?
Well, basically, a lot of the things that John said about the Fed in December, if you just flip it around, you basically have Mario Draghi and the ECB. Mario Draghi clearly put December on the table, but for additional stimulus, not for a tightening of policy. They've got an issue now of credibility because if you're a central banker and you specifically mention a meeting when you might act and you don't act, then you lose some of the trust in the markets. And so at this point, so right now what the ECB is doing is they're buying about 60 billion euros per month of mostly government bonds, kind of mirroring what the Fed and the Bank of England did. But starting it several years after other central banks did it. The ECB was late to the quantitative easing game. For the last 14 months, the ECB has also had a negative rate on bank deposits. So financial institutions that store their extra money at the ECB have to pay a small fee. What Mario Draghi did at his last meeting in October was basically to say that additional QE and an additional reduction in the deposit rate were options. And so at this point, you would expect that the burden of proof is probably on the data to be so strong that the ECB doesn't need to do anything. If you continue to get inflation around zero, so-so kinds of economic growth numbers, then the ECB would really be under a lot of pressure to add to the QE and to reduce the deposit rate. The ECB will always say that it makes its policies based on the European economy and that it doesn't look at what the Fed's doing. But the reality is when the Fed pushed off its rate hike from September, you had the dollar rise against, or the euro rise against the dollar, and that weighed on European inflation, that weighed on European growth. So the ECB can't be completely oblivious to what the Fed does. If the Fed raises rates and it becomes, the ECB moves, decision is before the Fed's in December. But if it becomes pretty clear that the Fed's going to be raising interest rates, that might take a little bit of pressure off Mario Draghi to add to the stimulus. But at this point,
We'll get into the issues around currencies and other things that come out of this, because obviously these things have these big global impacts both in China, Europe and the US. But just quickly, just on the Bank of England, just to bring in Jason here, one question I have is there any way that the Bank of England would move before the Fed, or whatever happens, are they going to wait till the Fed does something?
It looks very unlikely now. I mean, it wasn't that long ago that was possible. I think not long after Mark Carney arrived in 2013, and even early 2014, it did look like the bank was going to go before the Fed. And we wrote a bunch of stories about how this might be a test case for the Fed whenever they did eventually act. But it looks unlikely now. I mean, the Fed may go in December, they may go early next year. There's no inflation in the UK, so the pressure is off the bank to have to move before the Fed. If they did go before, you would have a big spike in sterling, which probably wouldn't help things very much. So I don't think they will. I mean, they're often accused of just acting in lockstep or waiting for the Fed to do things before they follow. But I mean, there's not a mechanical relationship, but I don't think there's any need for them to do something.
But I mean, coming back to the inflation question, and I think this is one of the big conundrums that central bankers have faced, which is all of this massive stimulus, even when coupled with very low unemployment in the US, has not resulted in inflation. What does the Fed think about that, and how does it factor in, given that they have this target of 2%, they're nowhere near that target of 2%, and yet they're talking about raising rates? Can you just talk a little bit about that?
You use the word conundrum, and that's really the key word. And the divisions, there are several divisions inside the Fed right now, and an important set of these divisions revolve around the question of what causes inflation, what drives inflation. So the leadership group at the Fed, this is Janet Yellen and Stanley Fischer, who's the vice chairman of the Fed, and Bill Dudley, who's the New York Fed president, have a belief in what's called the Phillips curve, that as the unemployment rate comes down, eventually that should create some upward pressure on inflation. This is an old idea that goes back to the 1950s. And the problem is that it's got a spotty track record, and it's got an especially spotty track record over the last 10 years. The US unemployment rate went up to 10%. That suggested that inflation should have collapsed and gone negative, and it didn't. And it's come down to 5%, and that suggested inflation should have picked up, and it didn't. Instead, it's been on this slow drift down. So there's the center of the committee, and then there's another group of officials who are the doves at the Fed, who are saying they don't want to do anything until they see real evidence that inflation is actually rising. And what's been very interesting about this part of the debate at the Fed is that you've had some regional Fed bank presidents outside of Washington in places like Chicago and Minneapolis, Minnesota, who've made the argument they want to see actual inflation actually rise before they move. But now you see it among Fed governors, people who are right down the hall from Janet Yellen. This is something I wrote about a few weeks ago. Two Fed governors, Daniel Tarullo and Lael Brainerd, are making the argument that they don't want to move until they see inflation rising. And this is something that Janet Yellen, this is an idea she has some sympathy to. She is among, before she became the chair, she was among the doves at the Fed. And at the same time, they're now challenging her mainstream point of view, which is that inflation will eventually rise. I think because of these tensions, what this boils down to is that if the Fed does move in December, there are still enough people on that committee who are so skeptical that the economy is ready for it, that they're going to wait some time before they make another move. That there are enough people inside the Fed who are going to say, all right, you get this move, but we want to see real tangible signs that inflation is rising before we move again. So I think you're going to see
a raise and then a very dovish statement after that to say nothing's going to happen.
I think there's a good chance that we see that.
But just on the Fed experience, and this plays into both China and Europe, I mean, is the belief in the Fed that QE particularly has done what it was intended to do? I mean, one of the things that it was meant to do was to raise inflation. It hasn't really done that. Growth has been reasonable in the US, but not what people would have expected coming out of such a deep recession. Do people still believe that that is the right tool? And in extremis, would they use it again? And do they believe that, you know, larger QE in Japan, in Europe, in China potentially is actually the solution at this point? What is the sort of debate on that?
Well, so, you know, there's what the Fed thought it would accomplish and what the public dialogue around it suggested it would accomplish. I think all along the Fed the leadership of the Fed understood that they were experimenting with something and they weren't sure what the results were going to be. They thought it would have beneficial effects. They thought there were also costs, but they didn't think it was going to solve the whole problem that a financial crisis caused. And when they do a lot of studies looking at what announcements of QE, the effects that they have on financial markets, they think on net it's been a benefit, but it's not a panacea. And they see effects in currency markets and stock markets and bond spreads when they announce these things, and also when they take them away. They would use it again if they felt they had to. And I think this is a big question that they could face in the years ahead. If we have another recession and interest rates are still near zero, they might not have any other tools to work with besides further expansion of their balance sheet. I think it's a real problem down the road that they're going to have to wrestle with.
But to pick up on John's point about QE, in Europe, it's almost, again, it's kind of it's a flip side. It's not so much in Europe a question of has QE been effective, it's would QE lead to the end of the world for the Germans? Because you had this debate in Europe that it was such a taboo, especially in Germany, for a central bank to be buying government bonds, that just the very fact that it hasn't led to rampant inflation, or it hasn't led to governments running extremely reckless fiscal policies, the fact that it hasn't had some of these dangerous side effects that people, especially in Germany, worried about, kind of already made QE a success just by the fact that it wasn't a failure. The ECB would say that it is having some positive effect on bank lending. It is having some positive effect on credit to households and businesses. But when you get to the ECB's target, which is to get inflation near 2%, QE and their very generous long-term lending program to banks hasn't generated inflation. So that's why they can do more. But for the ECB, it is more, Mario Draghi has benefited from the fact that it hasn't led to some of these
How do
side
they
effects.
balance, I mean, if they're doing further stimulus, how do they balance further cuts in interest rates, which are already negative, versus more QE? How do they think about that?
They would probably do both. What Mario Draghi said in September of 2014, when they cut the deposit rate to minus 0.2%, was this is as low as it was going to go. And then he had to backpedal last month at the ECB's press conference in Malta. He said a deposit rate cut is back on the table, another one. And he recognized that this posed maybe a little bit of a credibility problem for him. And his preemptive response was, judge my credibility on whether I meet my inflation target, not on what I said 1 year ago, was basically what he was saying.
Can I ask an additional question? So there's different ways that the ECB could expand QE, right? They could keep the program going longer than they've said before that they would go, or they could deepen it right now and do more or go into other asset classes. What do you think is the strategy here? Do they just keep it going longer, or do they increase it?
Again, it would probably be a combination of both, because I think what the ECB doesn't want to do is flag a December move and then just come with some real piecemeal approaches. We'll give you 5 basis points on the deposit rate, or we'll extend QE 2 months, or we'll add a few billion euros per month. If they're going to do something, they're going to have to do something that's pretty sizable.
And they see, just to be clear, they see significant they don't see significant downsides by doing either of those.
No.
It's a purely positive.
Draghi's approach seems to be to surprise people with more aggression than they expect.
Well, his approach is to surprise people, first of all, by committing the central bank to action before they actually do something. The QE was a perfect example. John, you remember you were in Jackson Hole in August of 2014. Mario Draghi kind of drops this little, reference to the weakening of inflation
I
expectations.
was getting emails from Brian saying this is a big deal.
It's just because it was late
Before
at
the
night in Europe
speech.
and I didn't want to do it. but he has had this, it's part of his strategy. He puts the ECB is a difficult governing council to shepherd through, especially big changes. You've got 19 countries. You've got 25 board members. You've got very well-known conservative principles in places like Germany, Netherlands. And what Mario Draghi has done, which is different from his predecessor, Jean-Claude Trichet, is been willing to go out a little bit on a limb before he necessarily has the entire governing council on board. But in doing that, you set an expectation for action, which is why December now becomes, in the market's eyes, such a likelihood. And then if you set that expectation, how are you going to surprise the markets again? You have to do a little bit more. So you don't want to get the market reaction that they want to get a weaker euro.
So let's talk about the markets here, because one of the big beneficiaries of zero interest rates and QE had been investors in stocks and other risky assets. And Jason, I mean, Mark Carney has talked a lot about this. How much does he think, if inflation, which we've talked about, remains very quiescent and you don't get any significant uptick and rates stay extremely low, negative, you have quantitative easing in certain places, what is the risk that markets do get too exuberant and that financial stability does get compromised here?
They're certainly alive to that risk, and the Bank of England, its approach maybe differs slightly to other central banks in that it's a great believer in these new macroprudential tools that they have. So they try and keep monetary policy very separate. I think the Fed's maybe a bit different here. So we had this problem last year with the housing market, if you remember. House prices were skyrocketing, particularly in London. There's a real sign that people were taking on much larger debts than they could easily afford.
And this is happening in other countries like Sweden, obviously,
Absolutely,
where you've got, I think, negative rates, and that's pushing the housing market up aggressively.
Yeah. And so what the bank decided, and there was a lot of pressure at that time on the bank to maybe think about an interest rate rise just to cool the housing market, but the rest of the economy wasn't doing so well. Inflation was on a downward drift. And what they did instead was tighten lending standards in the housing market. They imposed caps on how many loans banks could issue at very high loan-to-income multiples and so on. And to be fair, it seems to have worked, or at least
Jason, seeing all these cranes outside on your skyline here.
Sure.
I'm wondering if it's working.
Indeed. I mean, London.
That's not housing, that's commercial real estate.
Indeed, yeah. No, but it's a good point. And London is, we were talking about this earlier, London is a bit different to the rest of the UK. This was also in their thinking, because you had an economy outside London that maybe wasn't doing so well. You certainly had pockets of the housing market that would have done very badly had they raised interest rates. So they thought this would tackle the problem quite well.
The Fed, I mean, that's obviously been something that's always been a concern of the Fed's. Is that a live concern at this point? Do they think that markets are over-exuberant? Do they think that keeping rates at zero for another 6 months would create a risk that stocks, et cetera, get too frothy?
There are two lines of thinking at the Fed right now. So one is if you look at the price side of financial markets, and the other is if you look at the leverage side of financial markets. So if you look at the price side, you are seeing asset values getting stretched in some areas. Commercial real estate is a good example of one. In some areas of the residential real estate market, for instance, in San Francisco, residential real estate prices are going through the roof. And that's getting the attention of some people, and there is some concern about it. Janet Yellen's former research director, who now runs the San Francisco Fed, has said that he's getting concerned about it. Janet Yellen slipped it into a speech that she gave in late September that this is a reason to start moving on interest rates. So this is the price side. If you look at what's going on with bank leverage, how much debt financial institutions are taking on to fund asset purchases, that doesn't look like a big problem right now. So banks are very well capitalized. We're not seeing a lot of activity in the short-term funding markets, the repo markets, the kind of activity that Lehman Brothers and Bear Stearns depended on, and which led to their downfall. So there's two sets of views. There are some people inside the Fed who say they don't have to worry about it because there's not a lot of leverage in the system. And there are others who say, well, we're starting to see prices move. We have to be alert to this. And so there's some tension here. I think that at the end of the day, because we're seeing asset prices rise in some of these areas, it gives them an inclination to move sooner rather than later.
So that'll be a factor in December?
It is.
Yeah, okay. One of the other things that central bank policy has done, obviously, is to affect currencies. And one of the things Brian mentioned here was, not wanting the euro to appreciate too much because that will affect the economy. And there's a bit of a zero-sum game that some people have talked about with currency wars and other things. Lingling, can you talk a little bit about China here, where there was this rather strange communication around the revaluation of the renminbi and what's actually going on with the thinking on the currency from the central bank's perspective?
Sure. As you know, on August 11th, PBOC surprised the markets by devaluing the Chinese yuan by about 2%, and that triggered heavy sell-off of the currency, both on the mainland China and in the offshore markets in Hong Kong. So the PBOC's official explanation is that we made the move to make the currency more market-driven because China, as you guys know, they want the IMF to declare the yuan SDR currency this year. So that's the official explanation. But we talked to a lot of government officials, including those at the PBOC. Actually, a much bigger driver for the devaluation was the concern about slowing growth. PBOC, again, is under a lot of pressure from other parts of the government to devalue the yuan to help the exporters.
But is the expectation, one of the drivers of policy in some countries has been to explicitly devalue the currency, like in Japan. They have been very aggressive on quantitative easing to drive down the currency and make the country more competitive in some ways. Is the yuan likely to go down significantly more, and will the PBOC countenance that?
For the near term, before the IMF makes a decision on the SDR issue, China still has huge incentive to keep the yuan stable. But for the next year, in the next 12 months, the PBOC may allow a modest depreciation of the currency, something like 5%. Not significant, not sharp devaluation, because China is worried over huge capital outflows. Devaluing the yuan would cause more money flowing out of the country, so that's a big concern.
Okay.
But 3 to 5% devaluation, more downside.
Is the downward pressure on the currency coming from inside
The country, people trying to get their money out, or is it the government actively wanting the currency to weaken to support its export sector?
Yeah, that's a good question. There was a lot of pressure on PBOC to devalue because up until August, the yuan was the best performing currency in the whole world, but on a trade-weighted basis. So there are a lot of pressure from, for example, Commerce Ministry, which looks after exporters. At the same time, and after they devalued the yuan, the people really got scared. They're expecting more devaluation to come to help the economy, and then investors started to sell off the currency. So and taking money out. So then the pressure it was coming from the outside.
You had this strange situation where they devalued, then they tried to support it to stop it falling too fast.
Exactly.
Are they still explicitly supporting the currency at this point?
Yes, they still are. Because the reason that they intervened so heavily in the currency market was because some officials within the PBOC, even Zhou Xiaochuan himself, were caught off guard by the sell-off. They didn't realize the Malaysian currency, the Kazakhstan currency would have fallen so much, and that's why they intervened so much.
How much? This could be an area where we're heading for several collisions
Towards the end of the year, right? So we're talking about the ECB potentially easing by the end of the year, the Fed potentially raising rates. The Bank of England has said it thinks it would make a decision towards the turn of the year. But what I found so interesting about the PBOC's move is it happened before the Fed September meeting. So because the yuan is tied to the dollar, it seems to me that PBOC or Chinese officials, they didn't want more appreciation in the event of slowing growth there. So what do they do going into the Fed's December meeting when the Fed might turn around and tighten policy now?
And of course, if they're anchored to it, the dollar goes up, and
right. So
the
do they
yuan
move
goes up with it.
preemptively again before the Fed moves?
One thing is for sure, PBOC people have been following your coverage very closely. It's really interesting, for the better part of this year, whenever I talk to the PBOC people, they never believed the Fed would raise interest rates. And things started to change in the summer. They read more of your coverage, and
I hope I didn't mislead them because they didn't do anything in September.
No, you're absolutely right. They wanted to get ahead of the Fed, and that was actually one of the official explanations the PBOC people gave to the press 3 days after they made the move.
But what does that, I mean, talking of currencies, I mean, Brian has said that the ECB does think about, obviously, the value of the euro and what that means for exports and other things. How much does the dollar play into Fed decisions here?
Well, so what they tend to
Because it's
look
strengthened
at,
how much? I mean, it's up very significantly in the last 2 years.
What they tend to look at is financial conditions broadly. In fact, the president of the New York Fed, Bill Dudley, who's part of Janet Yellen's inner circle, before he went to the New York Fed, he was at Goldman Sachs and created a financial conditions index, which looks beyond just short-term interest rates and looks at other factors that affect financial conditions. So spreads on corporate bonds, junk bonds, the effects of the dollar, and short-term and long-term interest rates, of course, also. So what worried the Fed this summer, one of the reasons that caused them to delay a rate increase in September was that financial conditions were tightening, in part because the dollar was strengthening. It was strengthening because of worries about low inflation and also because of what happened in China. One of the reasons you're hearing them now talking about raising rates in December is that financial conditions have eased since that September meeting. The dollar has gotten stronger, and so that's a tightening of financial conditions, but we had a rally in stock markets, and spreads on corporate debt have narrowed and long-term rates have come down. So they're feeling a little bit more comfortable right now about financial conditions, even though the dollar has gotten stronger. Now, if we have these kinds of collisions that we're talking about with China and Europe again, then it could be a new alarm bell.
Let me ask you one more question, because we're going to go over the questions in about a minute or so. But when you look at the Fed now, they've had this policy of communicating very clearly with the market, or trying to. So for a long time, it was like, we're not going to raise rates, we're not going to raise rates, we promise we're not going to raise rates. Now they're trying to get the message that they are going to, and they've tried that a few times and then they've backed off. Right. If they do that again in December, at what point do they just lose credibility in terms of their ability to forecast and to communicate with the market?
So the way they would respond to this question is they would say that they've always emphasized that their decisions are data dependent, that they've said that they might raise interest rates. They want to give investors forewarning that it could happen, but it won't if economic conditions don't back up basically their projections. And this is what Janet Yellen said again today in front of the House Financial Services Committee, that if the economy lives up to the Fed's expectations, then it will move, if then. So they, I think, would argue that they're going to respond to the data and not to some sense that they're bound to move because they said they would move.
That's
but
what they'll say. But the reality is,
right,
the
but
perception is different.
The reality is, I think, in their heart of hearts, there are a number of people there who think their credibility is on the line. If nothing else, their forecasts are on the line. And if they don't respond after sending more of these signals that they could in December, then at the very least you have to say, boy, I don't trust their economic forecasts anymore because they keep telling us they're going to do it, and then the economy doesn't live up to their expectations. So there is pressure on them to move in December.
And Thurl, just to jump in really quick on the currency question.
Sure.
One thing to keep an eye on for the next few months is the central banks in Europe outside of the Eurozone. Because for the Eurozone, for the US even, I mean, they're huge domestic economies. if the currency is up or down, it's not necessarily going to have a big effect on the economy. But if you're talking about Switzerland, you're talking about Sweden, Denmark, these are small economies with a huge trade relationship with the Eurozone. And so if the ECB is going to ease, that's going to put even more pressure. So whereas the ECB has a minus 0.2% deposit rate, in Switzerland it's minus 0.75, in Denmark it's minus 0.75, you could really have central banks in Europe testing each other. How far can they go down on interest rates? How negative can they go? And this currency issue is going to be at the center of this.
And it's also in Latin America and Asia outside of China.
So buy real estate in Stockholm, is the message, is it?
Or
Okay.
Copenhagen, or
Very good.
or Zurich.
Are there any questions that people have they'd like to throw at the audience, at the panel here?
It's a question to John, really. Hi. To what extent do you feel the Fed are frustrated that they didn't start raising rates in June before emerging markets started going down and moving against them?
You know, people talk about how there was a window of opportunity early in the year, in March or in June, and they should have taken the chance when they had it to move. But I don't think that's the way they look at it. I mean, I think the fact of the matter is they weren't ready in June. They were looking at data from the first quarter that showed the economy had contracted. You know, they wanted real evidence that the economy wasn't on a new downward trajectory. And I mean, I don't think they're frustrated by the fact that they didn't move in June. I think it reflects the temperament of Janet Yellen and the temperament of the rest of most of the other officials that she's working with. And it's indicative of how this process is going to unfold. They're very, very cautious. They want to see real tangible evidence that it's time to move before they move. And so again, even if they move in December, you know, in that event they would move because unemployment has come down a lot, the job market and growth looks strong. They're going to want to see more tangible evidence after that before they move again. That's going to make this much different than other Fed tightening cycles. In the past, we've seen in the 2004 to 2006 period, the Fed went 25, once they started, they went 25 basis point every meeting. One thing I can tell you for sure is that's not going to happen this time around.
But then, so just to follow up on that, I mean, 25 basis points is tiny. I mean, presumably it's not going to make a huge amount. If they go 25 and then stop for 6 months, I mean, 25 is not going to make any difference, presumably.
And that's what they keep saying. That's what what they have been repeating over and over again is that investors, people in the markets are too focused on this first move. And Yellen just said it again today in her testimony, and she actually strengthened slightly this comment, that what really matters is the trajectory of rate increases after the first move. And we're going to be hearing this message if they do move in December. It's going to be very gradual, and it's going to be, you're going to see the same caution for the next move that we've seen this year. So it's feasible
you'll end up with a move that is actually more dovish than not moving, because they'll move and then be like, that's
it's possible. I think we could see some relief in markets that they're
the Bank of England has saying the same thing, that interest rate rises when they do start will be very gradual, limited. Their problem now is the market is pricing in interest rate rises that are so glacial, it's too slow for them. And so in August you had this peculiar situation where Carney was making a big fuss about a tiny inflation overshoot at sort of 3 years out in an attempt to try and push up the curve a bit, and this is a big problem for them. I mean, the big help for them though is the Fed, because that pushes right through into UK interest rate expectations.
What the market is saying to the central banks is threefold. One is, we don't believe your growth forecasts. The other one is, there's a risk of another recession that you're not taking into account with your interest rate forecast.
We're 7 years into a cycle, so that's a pretty long cycle already. So yeah,
exactly. And then the third piece is that we don't believe your inflation forecast. That inflation, you've missed the target for in the Fed's case 3 years in a row, and we don't think you're going to hit it anytime soon.
Right. And I think here the ECB is a cautionary tale for the Fed. The ECB had a window of opportunity to raise interest rates in early 2011. They took it. They raised interest rates twice, and it was a terrible decision.
Right.
They had to reverse them 6 months later, and then they were clearly
negative,
and then they went negative.
ECB, by the way, is the Fed's counterfactual on everything. So when people say, did QE work? you know, the Fed will say, well, we did it and the ECB didn't, and we're in better shape than they are, so therefore our policy was better. They wouldn't put it that way.
Factors, but yes, that's, yeah. Any other questions?
One question for John and one for Ling Ling, if I could ask both.
Please.
So
Why don't we start with Ling Ling, because John's been talking a lot.
So in PBOC, my question is, in contrast to the G3 central banks, where basically we have one variable, the policy rate, and whether that's being hiked or cut. The PBOC seems to have a number of levers that they can pull. And I'm wondering, as an external observer, which do you think are the most important ones that we should be focusing on? How do they operate in terms of their leverage on the economy?
Sure, that's a great question. For China, there are two benchmark interest rates that we pay a lot of attention to. One is the benchmark one-year benchmark deposit rate and one-year benchmark lending rate. And even though China has officially scrapped the ceiling on deposit rates and the floor on lending rate, the central bank still provides window guidance to banks in terms of what to charge borrowers and pay depositors. So those two interest rates are still of great importance if you wanted to see where the monetary policy is going. Another thing I would pay a lot of attention to is the CPI and PPI numbers, which indicates whether or not China is under inflationary or deflationary pressure. And right now, China faces a lot of deflationary pressure. So that means the real interest rates in the economy actually are going up despite the 6 interest rate cuts. And that means companies have a harder time paying off existing debt. So that's actually one of the biggest risks facing China's economy right now, the persistent deflationary pressure. And I would also pay attention to the RRR. That's the amount of deposit banks set aside at the central bank. China obviously has loosened RR requirements, since November. Yeah, the Reserve Bank reserve ratios, because right now, as you know, China for many years had relied on capital inflows as a source of liquidity, and now inflows have turned into outflows. The central bank needed to basically loosen, cutting the RR to make sure the market has enough liquidity in the market.
And just quick, a follow-up question related to that?
As long as it's quick.
Fiscal policy, do they have room on the fiscal front to stimulate from tax cuts or more spending?
Very limited room. The reason is China faces enormous fiscal challenges. Government revenues have been declining, or the rate of growth has been declining, largely because the housing market has been so soft. So the government is getting less from land sales. At the same time, they're trying to do all those different projects. So they have increased the spending. So the government is trying to, make the ends meet, so to speak. So the room for further fiscal stimulus is really quite limited.
You had a quick second question, so that's...
On the Fed, yeah. So, John, reading the statement that came out in October and comparing it to the September one, there was a pretty notable change in tone. But looking at the economic data in the meantime, I didn't notice any substantial change. So I wonder, you spoke earlier about the change in financial conditions, basically asset markets doing better in that period. Is that all that really changed, and was that sufficient to change the Fed's mind?
You're right. The economic data in some respects have gotten worse because we had a pretty weak jobs report for the month of September, I guess it was. A couple things have changed. One is financial conditions. Stock markets came back, bond spreads narrowed, and long-term rates came down. And then the other thing that changed, which is related to financial conditions, is that the PBOC eased policy, and the ECB suggested that it was going to ease policy. And I think that made officials a little less worried about the outlook for growth outside of the U.S. And as a result, they took out this important line in their statement which suggested they were concerned about the global outlook and financial conditions.
Another question.
I just had two quick questions, actually. First one for Brian about the ECB. Just wondering how much of the stimulus has actually filtered through to the real economy and how much is getting held up on whether it's bank balance sheets or debt restructuring, and how much is actually going into investment. And is that an explanation for the delayed effect? Are we going to see it take longer for QE to actually achieve an impact because of that?
It's slowly starting to have an impact, but it's hard to make an argument that all of this stimulus is on a euro for euro basis going into investment in the real economy. You're finally seeing lending to the private sector turn positive, but this is after years of contraction. And so there is evidence. I think initially the ECB stimulus was being used by banks to buy securities, to buy bonds. That's why you had the huge compression in yields in Spanish bonds, Italian bonds. Now, given that yields are so low, that's not a very attractive investment anymore. So you're starting to see more, and you see this in the lending data and in the bank lending surveys, that the stimulus is starting to find its way to lending to the private sector, to households, to businesses, but it's a slow process. It's not. They definitely don't need to worry about overstimulating the economy at this point.
The second question was for John, actually. How significant do you think the persistent low oil price environment is in sort of dampening inflation forecasts and the effects of any rate rise?
Well, the standard line at the Fed is that oil prices aren't going to go to zero, and they certainly can't go below zero. So, at some point, this is likely to wash through the system. So, if oil prices stabilize between $40 and $50 a barrel, then the downward pull on headline inflation indices ought to start kind of disappearing later next year. And we ought to see headline inflation start rising. And that's why the Fed looks at core inflation, excluding food and energy prices, and that's actually been very stable. We're not seeing a lot of pass-through into core inflation, and that's why there's some confidence in Yellen's inner circle that they might be getting close to making one small first move.
At the back there.
Hi, thanks very much. I just have a slightly sort of left field question, but it's regarding fiscal policy. I mean, how frustrated do you think debt management offices are, given that they're stuck between a rock and a hard place in terms of the need for austerity across probably all the economies that you guys cover, and the central bank easing actually having a positive effect on yields?
A go at that, Jason. Was that directed at anyone in particular or just in general?
Probably more from a UK and I guess a European perspective, I think.
The debt management office specifically? You're
basically asking about the conflict between monetary policy and fiscal policy coming at different sides, yeah?
Fiscal policy in the UK is going to stay tight for a long time if we believe Mr. Osborne. Monetary policy will probably still have to do most of the heavy lifting. In fact, funnily enough, the fiscal consolidation is starting to creep back into what the MPC is talking about. It appears again in the minutes. Carney keeps mentioning it. I think they see it as quite a big headwind. Osborne did not achieve the fiscal consolidation he had planned in the first Parliament. He's going to look pretty stupid if he doesn't do it in the second. So the chances of him wanting to slip are probably slightly less. I think it's going to be still a pretty big headwind.
In Europe, it's a significant issue as well?
Well, it's a bit of a mess in Europe. You've got, you can make an argument that a lot of the countries in the Eurozone need more fiscal stimulus. France could probably use more fiscal stimulus, Italy, Spain. And yet the Stability and Growth Pact, which sets these limits on the deficits, even though the countries don't always necessarily pay a lot of attention to those, it still forces them to keep their deficits probably lower than they should have been, given the weaknesses in the economy. And then on the other hand, you have Germany that runs a surplus. And so a lot of people in Europe would say, why doesn't Germany run a really expansive fiscal policy? Pump up their own economy so that they can actually start importing more instead of just relying on exports, and they're not going to do that. So, and meanwhile, you have the ECB that recognizes, they always say that other actors in the economy need to take on more of a role. They always say, kind of, stop looking at us to solve all your problems. And yet at the same time, the governments are kind of hamstrung in terms of what they can do because they can't run their deficits over a certain percentage of their GDP.
So it's still down to central banks.
We've got one of the wheels turning in the U.S. right now is fiscal policy. It had been a headwind for most of this expansion, and it's become neutral in the last year. And the White House and congressional leaders just reached this agreement, which could bust some of the spending caps. So we might see a little bit more coming out of the fiscal side in the US.
We've got time for 2 more questions, just at the front here.
I have a question primarily to John, but I mean, if the others want to chip in, they're more than welcome. It's on the diverging views on wage growth, primarily at the FOMC, and the risks and benefits of wage growth in hitting the targets, both when it comes to economic growth and inflation, which both have been undershot for a very long time, and if there's any influence from the ideas of secular stagnation, being invented by Larry Summers and others, as sort of an overall demand deficit holding back growth.
Well, so what the Fed has been expecting as the unemployment rate has come down, it hit 5.1% in the last couple of months, is that as slack in the labor market tightened, that they would start to see some increase in wages, and they haven't. They've been very surprised that they're not seeing wage growth. And it's one reason why the doves that Yellen is trying to bring into the consensus are reluctant to do anything on interest rates. They want to see tangible evidence that either wages or consumer inflation are rising. One of the problems here is this conundrum that we were talking about inflation. If you look at the relationship between inflation and wages and the Phillips curve, it isn't clear that these mechanisms work, that an increase in inflation, for instance, is going to lead to higher wages or vice versa. So it's a problem that is strengthening the hand of Fed officials who don't want to do anything. They want to see real signs that it's moving. And it's, again, why we got to watch these jobs reports, and in particular the jobs report that comes out Friday, for some signs that there might be some movement there. If they see movement, they'll be more inclined to move.
Is there a last question?
Hi, yeah, a question for Brian mainly, but for the panel too. I mean, to what extent do you think the ECB had dropped the ball during the crisis? That it's only doing QE now because it would have liked to move sooner, but institutional weakness stopped it doing so.
That's a great question. The ECB, it's pretty easy to beat up on the ECB and say they should have done something. They should have done something earlier. They should have done QE 2 or 3 years earlier. But the Eurozone is just such a complicated setup, and they were not a lot of other central banks have to deal with both managing their economy and having this role that the ECB had in managing Greece's debt crisis. So in a sense, yeah, the ECB probably should have been more proactive in its monetary policy. It shouldn't have raised interest rates in 2011. Probably should have done QE sooner, but they had a lot on their plate since 2010 that I think a lot of other central banks are glad that they don't have to deal with. So, in hindsight, yeah, they probably should have done more sooner, but dealing with the Greece crisis, I think, was a real curveball in terms of setting monetary policy.
Well, thank you very much. There'll be some drinks afterwards with the panel, so if you have further questions, you can direct them to them individually. But thank you all very much for coming. Thank you for tuning in on the live stream, and thank you all for flying in from various parts of the world or taking the lift up, and much appreciated. Thank you.